The stock market is officially closed right now, as today is Sunday, June 21st, 2026. Because the regular trading session is inactive, we have to look at where the numbers settled at the final bell. Nvidia stock finished its last active session on Thursday, June 18th, 2026, closing at exactly $210.69 per share. This capped off a highly volatile day where the stock pushed to an intraday high of $211.39 after bouncing off an intraday low of $206.50. That final print represents a notable upward move of nearly 3%, specifically a gain of $6.04 on massive trading volume that reached over 241 million shares, easily outpacing its standard daily average of around 161 million shares. While a casual glance at this performance suggests typical tech giant strength, a massive undercurrent is developing that most retail participants are completely missing. Just days ago, Nvidia corporate leaders filed paperwork to execute a massive $25 billion bond issuance, marking their first return to the corporate debt market in 5 full years. Why would a company sitting on mountains of operational cash choose this exact moment to take on significant multi-tranche debt? The public expects this capital to quietly service short-term obligations, but the reality is that institutional desks see this as an aggressive war chest assembly meant to completely choke out competitors before their next-generation chip architectures even hit the production line. When you scan the popular retail trading channels, from discussions surrounding the Robinhood app to online forums dedicated to self-investing, the collective consensus is simple. The general belief is that Nvidia stock is an automatic buy because the artificial intelligence hardware build-out will last forever without a single speed bump. People look at their personal tracking platforms, check their balance sheets on the Robinhood trading platform, or review allocations within a Schwab Intelligent Portfolio setup, and they assume the upward trajectory is completely guaranteed. It is easy to understand why this mindset dominates the public consciousness. We have watched hardware demand break every historical metric over the last few years. But challenging that conventional view requires looking at the structural shifts happening underneath the surface. The easy money from the initial infrastructure build is changing shapes. We are moving away from a phase where tech firms bought any silicon they could find at any price, and entering a phase focused on inference deployment, sovereign data center networks, and specialized commercial execution. Retail investors using basic investing sites often fail to realize that when expectations are this high, even matching a stellar earnings report can trigger a massive institutional sell-off. It creates a fascinating tension between what the public thinks is happening and what the institutional ledger actually reveals. Looking closely at the recent daily swings, the technical footprint of this asset tells a story of intense accumulation hidden behind broad market chop. Over the last month, the asset has experienced a calculated retest of its critical support range between $195 and $210, backing away slightly from the all-time high of $236.54 achieved back in mid-May. When a stock pulls back on lighter volume and then suddenly surges on 241 million shares, as it did at the end of the week, it indicates that institutional block desks are actively defending the floor. Large fund managers utilizing professional tools like the Interactive Brokers platform or managing diversified portfolios through Fidelity brokerage accounts are reallocating capital away from second-tier software names and piling back into the primary hardware layer. This sector momentum was further accelerated by broader macroeconomic developments, including recent political discussions regarding domestic supply chains and manufacturing agreements, such as the high-profile domestic chip production deal struck between Apple stock and Intel. When massive macroeconomic shifts occur, the money always flows back to the underlying computational architecture, which directly benefits Nvidia stock over individual consumer tech brands. Comment below how many shares of Nvidia stock you currently hold in your portfolio and whether you are buying this recent dip or waiting for a deeper pullback. To fully understand why this price action matters, we have to look at the structural reality of the corporate balance sheet and what this business actually does. Nvidia designs the ultra-high-end graphics processing units, network interfaces, and software development stacks that serve as the foundational bedrock for all modern deep learning models. Their business model relies heavily on a fabless design structure, meaning they handle the complex architecture and programming ecosystems while outsourcing the physical fabrication to specialized advanced foundries. For years, the market viewed them simply as a cyclical component maker, supplying high-end hardware to PC gamers and cryptocurrency miners. Older financial reports from several years ago show a business that was highly vulnerable to consumer spending trends and supply chain gluts.
However, the massive institutional shift towards centralized data centers transformed their revenue profile, turning them into an infrastructure monopoly boasting net profit margins above 62%. This level of profitability is almost unheard of for a company carrying a total market capitalization floating past $5 trillion. Their proprietary software layer ensures that once an enterprise or cloud provider builds their software stack on Nvidia architecture, switching to an alternative competitor becomes an incredibly expensive and logistically painful endeavor. This brings us back to the psychological battle between expectation and reality as we look toward the future outlook for this chip giant. The market currently expects flawless execution, zero supply chain disruptions, and an endless runway of hypergrowth. If reality merely matches these expectations, the stock could trade sideways or face valuation compression, which is why individual brokerage accounts must be managed with extreme precision. However, if reality exceeds these lofty projections, the upside potential remains massive. Consider the upcoming production ramp of their highly anticipated next-generation architecture. While retail traders on platforms like SoFi Invest are busy looking at trailing price-to-earnings ratios, institutional analysts at firms like Wedbush and UBS are looking at cloud infrastructure providers who are accelerating their upgrade cycles ahead of schedule. International operators are building massive AI-capable clouds across regions like South Korea and the United Kingdom, specifically choosing next-generation hardware pipelines to power commercial inference applications. Inference is the actual deployment and execution of trained models, a market segment that is projected to scale significantly larger than initial training infrastructure. If these international sovereign networks treat computational capacity as a national utility, the addressable market expands far beyond what traditional technology models predict. Yet, this massive potential does not mean the asset is completely devoid of near-term risks that could shock self-investing participants. The company operates within a delicate geopolitical ecosystem, and any sudden friction in global manufacturing hubs could instantly bottleneck their ability to deliver physical products to clients. Additionally, as major technology clients look at their massive capital expenditure budgets, there is a growing incentive for them to develop custom internal silicon to reduce their reliance on a single vendor. We are already seeing large infrastructure players explore diversified supply lines, which can introduce customer concentration risks for specialized component suppliers across the entire industry. Traders using traditional investing sites must also watch how the corporate bond issuance affects cash allocations. While raising $25 billion through multi-tranche debt gives the firm immense strategic flexibility, it also changes the capital structure during a macroeconomic period where cost of capital is a critical variable. If enterprise software adoption stalls, or if corporate clients realize that monetization timelines for advanced applications are longer than originally anticipated, hardware demand could experience a sharp deceleration, catching over-leveraged retail accounts completely off guard. Navigating this asset requires shifting focus away from short-term market noise and focusing entirely on structural indicators. When you look across the entire digital ecosystem, whether you prefer tracking your assets via the Fidelity mobile app, managing options through the Robinhood trading platform, or utilizing automated rebalancing within a SoFi robo-advisor setup, the central question remains the same. Are you buying into a temporary market top driven by peak hype, or are you accumulating shares of a foundational infrastructure provider that is currently trading at a relative discount to its long-term earning capability? The core conflict between market narrative and operational truth will ultimately dictate the next major structural trend for this stock. If the operational execution remains flawless, the current support level near $210 will likely serve as a launchpad for a retest of all-time highs, potentially pushing toward the higher-end institutional price targets that sit well above the current valuation. Ultimately, the closing price of $210.69 on June 18, 2026 serves as a clear reminder of how dynamic this market remains. The expectation surrounding Nvidia stock is heavily tied to the belief that its growth trajectory will be a smooth, uninterrupted line upward. The reality, as demonstrated by the recent institutional debt issuance and the ongoing retest of critical support zones, is much more complex, requiring deep patience and precise execution. True wealth generation in online investing does not come from chasing green daily candles or panicking during brief market pullbacks. It comes from understanding the underlying mechanics of institutional capital flows and recognizing when the broader public is mispricing structural demand. By maintaining a firm grasp on asset margins, hardware upgrade cycles, and global sovereign deployment pipelines, you can position your personal portfolio to navigate the volatility of the tech sector with absolute confidence and strategic authority. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Like, comment, and share this video to support the channel.